This is the Daily Market Rundown live from the Tradelo Trading floor. It's October the 25th and some highlights from today's show. European inflation expectations are sinking fast. SP 500, let's look at the technicals, and the German Shatz is in play. Good day traders and welcome. Let's start with some of the overnight news. We turn our attention to Japan. We had some of the inflation numbers out there. It matters because of course the BOJ has been reluctant to move on interest rates since July. In essence, the only reason they hiked in July was perhaps to stem some of the speculation that was going on with regards to the yen. Keep in mind, Japan currently has a negative real rate of around 150 basis points. When we compare that to the likes of the United States, they've got a positive real rate in the region of somewhere around 200 basis points. So that divergence means that speculators are absolutely right in their minds to be continuously shorting the yen, and we see that yen under some significant sell side pressure over the last couple of weeks. We are at this point in time 5.5% down this month in the Japanese yen. So don't be surprised to see more weakness come into that Japanese yen. And of course, if we look at those inflation prints, they don't exactly spell out a BOJ that's going to be hiking anytime soon. There was some thought that the BOJ could hike again this year, but it seems like the only reason the BOJ would hike again this year is to stem further weakness in the Japanese yen. Now, the numbers were more or less bang on in line, but if we look at the headline CPI from Tokyo, it very much was, previously we had a print of about 2.2, it was expected to come out 1.9, but it missed 1.8, and that's quite a significant drop off. They're back below that 2% sort of target. If we look at the X energy, we look at it, previously 2% was expected, 1.7 came in marginally higher. But the point is, it's not exactly a set of data points coming from Tokyo that give the BOJ any reason to be hiking again this year. So like I said, keep an eye on the yen. I do suspect that's going to continue this weakness until, of course, we do get either higher rates from Japan or a Fed that decides they need to be cutting a lot more aggressively for whatever reason that might be. Now, we also had, of course, Tesla was very much in vogue yesterday. It was a market that soared. It had a fantastic move yesterday. It was up around 18%. Well, it's up around 18% this week as a result, of course, of those earnings. That aside, we have had some updates from the Middle East and some of the tensions there. It does seem like a strike is coming at some point, but we've almost had some positive news in a sense that we've had sources come out and tell us that, should the Israeli strike be somewhat limited in what it destroys and not escalatory, there's no need for Iran to counterattack. It does seem as though that attack is coming. Most likely it'll happen over a weekend because it just means the markets are shut. It doesn't create any unnecessary volatility in some of the key markets. So again, like all things, keep an eye this weekend. If there is that attack, of course, we do want to be fading any kind of a gap up in the oil should there be a gap. Okay, market participants are well aware of this attack, so it's not necessarily new news. Now, the key news I want to kind of focus on and turn my attention to is again ECB, and we're going to keep harping on this ECB because it's a theme that's continuously developing. But the reason why I think it's so important for traders, obviously not many of you were around in 2013-14 when the ECB finally began the process of quantitative easing. But what happened back then and why it was such a significant period for the ECB, Europe, and of course the euro was they effectively were running a very negative interest rate policy at a time when the Fed was actually coming out of sort of a very negative interest rate policy. And what that resulted in was a significant divergence between the differentials that you would receive in Europe versus the US. The result, the euro dropped from 2014, it dropped 36%. Okay, that was a significant depreciation in the value of the euro. And the reason I mention that is because we are seeing something very similar now starting to play out in Europe. Now, There's an article out overnight. It's a bit of an opinion piece, but what it's pointing towards is we've obviously got the IMF that's come out, and they've lowered next year's growth expectations for Europe to below what the ECB has it, but that's not new. The key takeaway is that we're now seeing 1-year inflation expectations around that 1.7 mark. Okay, what that means is the market thinks that the ECB is only going to be generating around 1.7% inflation starting 1 year from now. Why does that matter? Well, because the ECB's objective is 2%. Just before the ECB came out and begun the process of cutting rates, we've sunk below that 2%, okay? Yes, we had a little bit of a bounce, but what you can see over the course of August, September, October is that inflation expectations are very well contained below the ECB's target of 2%, okay? And this is problematic for the ECB because inflation expectations is not one of those things that you suddenly just rescue. The only way the ECB turns us around is if suddenly we get a growth shoot out of Europe, suddenly Germany heals, suddenly French manufacturing and services bounces, or you cut a lot more aggressively and provide a lot more stimulus to the market. The reality is the ECB is going to have to provide a lot more stimulus. Now, two things to point out. If you look at the second vertical line, that was when French PMIs released back in September had a significant miss that came in well below 50. Yesterday, what happened? French services PMI missed again to the downside. Sure, Germany have a little bit of an uptick, but the reality of the situation is that services PMI is sinking very fast in Europe, and this is the only thing that's been holding up any kind of remote growth for the EU. So keep a very close eye on this. I suspect the pivot is coming very, very shortly. I think we'll get a pivot in the next 2 weeks. We have, of course, got some European CPI data out next week. Should that miss to the downside, guess what? This is going to continue lower, and once we get below this 168, you can guarantee that the rhetoric at the ECB is going to pick up. Now, I had a comment on Twitter, and it was a fair comment, which was some of the ECB members are pushing back on this. The reality is that ECB members are always going to push back on this because they don't want to reignite any inflation. Moreover, central bankers in general always want optionality. So they're not going to come out and say, yes, 50 basis points is likely in December until they are very, very certain that that is the consensus forecast. Okay, so right now, they do play a little bit of insurance, make sure they got full optionality, make sure they can get as much data as possible before they commit to more aggressive cuts. But looking at this chart, looking at what's going on in Europe, the reality of the situation right now is that the ECB is going to be called upon to act a lot more aggressively, and it's coming pretty shortly. Now, if we go and have a look at some of the overnight market moves and sort of some of the key takeaways, there's not much going on. Okay, and I think that's going to be a key theme now for the next 2 weeks or week and a half as we move into this US election, is that the markets are mostly going to move sideways. If we take a look at the Magnificent Seven this week, okay, read off a couple of numbers. Microsoft up 1.5, Apple down 1.8, Meta down 1.5, Alphabet pretty much down 0.4 on the week. Okay, in other words, the big names, the Mag 7, are not moving anywhere. Why? Well, because no one wants to take any kind of risk now as we move into this US election. Okay, everyone that has their positions on, they have them on. There will, of course, be a bit of hedging going on as we move into the actual election date, just in case. But in reality, we're not going to see a great deal of position taking now until that election result is out of the way. So factor that in. Make sure you don't overcommit for the next 2 weeks. And don't worry, once the election results out of the way, markets will return to normal, volumes will return, and as a result, volatility will also return. Now, let's go and take a look at some other interesting charts, and what I'll point out to you is that one of the key things I'm focusing on, and it's one of the key plays now, and it's the trade of today, is very much the German Shatz 2-year. Why? Well, if we go back and we look at the period of sort of sinking inflation expectations back in 13-14, the Shatz is very highly correlated to inflation expectations. Okay, in the 2-year we've got the Shatz, nice purple line. In the orange we've got 1-year inflation expectations, and what you can see is that the 2-year in terms of yield has very much attached itself in terms of the pattern. Okay, sell off, consolidation, consolidation. Okay, Schatz is in play. Schatz is going to continue to move lower. I expect the Schatz to sink all the way down to somewhere around this 1.2, 1.4 over the coming weeks as we move into that December meeting, because I expect the ECB to be forced or backed into a corner and forced to cut more aggressively and provide the stimulus that the market is talking about. Now, one key takeaway is that Morgan Stanley's come out and they said that the neutral rate for the ECB is negative. Okay, what they mean by that is they think the ECB needs somewhere between 50 and 100 basis points of negative real rates to ultimately stimulate inflation. Okay, so let's assume this does sink down. Where is the rate of interest rates that allows the ECB to provide, for example, 100 basis points of neutral of real rates? The reality is that assuming inflation, let's say 1 year out, is at 1.5, the ECB is going to need, roughly speaking, an interest rate of 50 basis points to have a sufficiently negative real rate. In other words, what does this all mean in very, very plain, simple English? Okay, right now, ECB interest rates are sitting at around 3.25%. Okay, so to get to 50 basis points, that is roughly speaking 275 basis points of cuts that they need to do in a relatively short space of time. What's the market's currently pricing? The market's thinking around 25 basis points at every coming ECB meeting. But in reality, if this sinks below 168, the ECB is going to have to get their skates on to get to a more neutral level and perhaps even to a level that provides some sort of stimulus. Okay, what that means is if things do get below this 168, we're going to cut 50 in December. We're going to need to cut again another 50 when we get to the January meeting. So the point is that the ECB needs to get their work and their act together. Otherwise, we are going to see these inflation expectations drop more aggressively. That said, let's turn our attention to some of the technicals and just to showcase to you, the market's coiled up. Okay, this is the SP 500. You can see now for the last 10 days, we are absolutely flat. There's no need to pretend like there's going to be any trend to the upside or downside because we're pretty much going to probably be trading these prices by the time we get to US election day. Okay, that is the reality. Yes, you might see a little bit of upside volatility. Yes, you might see a little bit of downside volatility, but price change from this point forward over the next 2 weeks is probably going to be unchanged. Factor that in. You're going to see a lot of dojis. You're going to see a lot of sort of erratic type movement. But at the end of the day, if we look at a weekly chart, 2-3 weeks from now, you'll probably see some form of an unchanged week. Okay, factor that in. The key levels remain 5,800. It's been like that for 2 weeks. To the upside, 5,900. We're going to sit within this range most likely until that election result. Okay, and then finally, our play of the day. Like I said, it's got to be long Shatz. German bonds are very much in favor now. And just to point out to you why I like this chart, it's a 60-minute chart, but I want to just showcase to you that was the ECB meeting. Okay, what did the ECB deliver? A little bit of a hawkish cut. They maintained this idea that they need to keep a data-dependent approach and a restrictive level of interest rates. The result is ultimately, initially, the market went bid, but then it said, well, look, that's a little bit hawkish. It's not quite the dovish stance we expect. It's not quite this opening a door to a 50 basis point cut. And so in reality, the Shatz sold off. The point is, Shatz has gone sideways since that ECB meeting on the 17th. Okay, so last week, Thursday. So what happens now? Well, look, we've got a very clear line of buying sitting here around that 106.81s. I do expect once we get above that 107 level, it does confirm that the market is starting to become more comfortable with this idea that front bonds are going to need to rally and rally quite aggressively into December. Okay, keep a very close eye on that. It is the play of today. It is the play of the week. It's the play of the month. It's the play of the quarter. Long Shatz is now in play. It's very much going to be a consensus play over the coming days and weeks. Okay, let's then have a look at some of the sort of expectations for today. There's not a great deal in terms of data in the way. We had some of the key data out yesterday, but this is the end of the week. Not much to talk about in terms of data expectations. Like I said, keep an eye on the weekend in terms of any kind of an Israel strike. Apart from that, we do of course have the UK delivering their budget next week, which will be an interesting one. So study up on that. Have a look at what some of the opportunities might be there. Otherwise, that's it for today. Good luck out there. Always manage your risk. Go make some money.